It's June 30th, 2026. This essay is on the U.S. leading economic indicators. At the moment, the economy is decelerating. We're not in a technical recession, but depending on who you are and where you're at, it may feel like it. This is good for buyers and a cautionary tale for sellers. At the 60,000 foot level, consumer confidence is down. Consumer expectations are down. Business confidence is down. New housing under construction is down. New mortgage originations, however, are up. Home price indexes are essentially flat. Changes in private inventories are down. The federal funds rate is flat. Real M2 money supply is flat. Velocity of money is flat. And the inverted yield curve is also flat. But last but not least, GDP now is actually up. As of today, of the 12 leading economic indicators, 2 are up, 5 are down, and 5 are flat. On balance, what this is telling us is that the economy is hanging in there, but inflationary price pressures have both consumers and businesses stressed. The best data point I have to illustrate this is personal consumption expenditures. This is personal consumption expenditures, both in today's dollars and in 2017 dollars. The top line here is personal consumption or spending in today's dollars. The bottom line is personal consumption spending in 2017 dollars. The gap between these two lines is the lost purchasing power consumers are experiencing today. What this chart is illustrating is that your 2017 dollars are only buying about 69 cents of goods and services today, and that hurts. Bottom line, consumers are spending money, as most of you can attest, but you're simply not buying as much. Next, we'll be looking at each individual data point. Before we do, here's my 15-second advertisement. If you're looking to buy or sell personal residence or a business, or if you're looking to buy or sell a commercial property, give us a call. We know what we're doing. Now we'll look at each of these 12 leading economic indicators at ground level. This is consumer confidence. Everything above this red line is positive, and everything below the red line indicates recession territory. As you can see, we're in recession territory at the moment and have been for kind of the last 12 months. The black line on top here is consumer expectations. And consumer expectations have been softening for the last couple of years. It's not technically a recession territory, but at the moment, but as you can see, consumer expectations have been, sliding downward for a while. Next, we'll look at business confidence. This is the business confidence index over the last 75 years. Now, as you can see, maybe not every time, but about 80% of the time, it drops below 100. It signals an upcoming recession. And today, it's at 98.97, so it's pretty close. This is a picture of business confidence over the last 10 years. In 2015 to 2017, business confidence went negative. But given, about $2 trillion in deficit spending, we avoided a recession, at least this time around. Next, we'll be looking at new housing under construction. This is new housing under construction. I really like this leading indicator. It's been, accurate almost every single time over the last 50 years. It's not fast, which means, it can actually front a recession by a couple of years. But home builders, as a group, are on the leading edge of experiencing consumer sentiment. And as such, home builders are a pretty good indicator of what's coming in the economy. Next, we'll look at new mortgage originations. This is new mortgage originations. It's a great example how difficult it is to rank these data points. Question, is this graph showing us a weak economy or one that's expanding? If you look at the last 10 years, we're 35% below normal. And that would argue that, real estate's in a weak spot. But having said that, in the last 12 months, new mortgage originations have bounced up, and we're up over 20% from the lows of 2024. That argues that residential real estate is picking up. So, which is it? Is the market strong or weak? Well, for today, I'm looking at the short term, which is to say, given the market is up over 20% from its lows, I've marked this data point as being positive. But again, having said that, new mortgage originations are below their long-term trend lines. This is the Case-Shiller National Home Price Index, and at the moment, it's flat. But at the same time, the Federal Reserve's National Home Price Index is actually slightly up. All told, I've marked the home price indexes as flat at the moment. Real estate prices across the board are holding, at least for now. Next, we'll take a look at changes in private inventories. This is changes in private inventories over the last 50 years. It's actually a really good indicator, or a coincidental indicator at least. You can see that each of these red circles that changes in private inventories have accurately tagged each recession we've had since 1970. That's 56 years, and that's doing pretty good. Let me explain what this is actually saying. When a business sees sales slowing and the market's cooling off, companies take a step back and they stop ordering new product to put on the shelves. In turn, they burn down inventories. And as such, when inventories start to drop, as you can see here, it often argues the economy is cooling off. Now again, changes in private inventories is a good leading indicator of recessions. And that being said, changes in private inventories are arguing we're in a recessionary territory right now. Next, we'll look at the federal funds rate. But first, and this is important, the federal funds rate is an axiomatic truism. Now, question, what is an axiomatic truism? An axiomatic truism is a statement or a proposition that is regarded as self-evident. It's universally accepted and taken for granted without, the need for formal proof. The axiom is that if, and the operative word is if the Federal Reserve drops federal funds rate, the market will expand. Politicians and legacy media have been saying this for years. It's an accepted truth, but it's not. The federal funds rate and the economy are not inversely related. Take a close look at the data, and you'll see that the federal funds rate is a leading economic indicator of a recession, not the opposite. A drop in the federal funds rate signals a recession, not an expansion. That's been true for over 75 years. That will be a little hard for some people to absorb, but it's true. Taking a little closer short-term view, this is the federal funds rate over the last 10 years. As you can see, it's been dropping for the last 18 to 20 months. And again, that has historically indicated or preceded a recession. Point being, as a leading economic indicator, it's something to keep an eye on. Next, we'll look at money supply and the velocity of money. Money supply and velocity are two data points that go hand in hand. Much like an individual family household with, mom and dad and two kids, they have a mortgage and bills to pay. They're a micro-level economy all by themselves. The point being, how much money they have in their hands at any given time and how fast they spend it indicates the strength of their personal budget or economy, just the same as entire markets like the U.S. economy. As such, money supply and velocity are leading economic indicators of the entire U.S. economy. This is real M2 money supply. The point I'd like to draw your attention to here is the red circle that outlines the fact that in 2020 to 2023, with COVID, the Fed printed money like there was no tomorrow. And that is why we've experienced, 30+% inflation over the last five years. Summarizing, where we're at today, money supply is up a modest 1.35%, which is good. Now let's look at velocity. As you can see here, the velocity is also up modestly at 1.43%. Again, all things being equal, this is a good sign. At this point, both money supply and velocity are giving neutral signals. Next, we'll look at the inverted yield curve. The inverted yield curve has, accurately forecasted recessions for the last 50 years. There's only one problem. It is also a really slow-moving forecasting model. It can play out months to years in advance of a recession. So from a planning perspective, and in making decisions, it's more like a yellow flag at a car race. It doesn't mean stop driving or stop doing whatever you're doing. It more or less is a caution flag that tells you to slow down and keep your eyes open. Next, we'll take a look at GDP now. GDP, or gross domestic product, is the official barometer of when we're in a recession. It takes 2 consecutive quarters of negative GDP growth to register officially as a recession. The problem is that it can take upwards of 12 to 15 months to confirm it. The point being, we could be in a recession today and you would not even officially know that until next year. That's why the Fed came up with GDP Now. There are over a dozen economic subcomponents to GDP Now. They throw all these numbers into a giant algebraic formula, and out pops what they hope is a leading economic indicator. It's only been out since 2014, so, in all honesty, it'll take years, if not decades, to know if it really works. But as of today, the GDP Now model is in positive territory. So it's telling us that everything is okay. Let's go back to the 30,000-foot level. In summary, given these 12 leading economic indicators, 2 are up. New mortgage originations and GDP Now that we just looked at. And 5 leading indicators are down. Consumer and business confidence, new housing under construction, and changes in private inventories are all down. So, what does all this tell us? Well, as of today, the economy is technically okay. But, having said that, as I mentioned a moment ago, there's a yellow flag on the racetrack indicating drivers should, exercise some caution as we move forward. I hope this helps. I report on these leading economic indicators every month. So if you want to stay informed, hit the subscribe button and the like button. That would help. Now, if you're a real estate broker and want to join my team at EXP, just hit the link below and I'll send you a short introductory video. Until next time.